That's where people have gotten themselves in trouble is you get a kind of good news, like we're seeing with some of the earnings, you get this proverbial green light, and then you get a pullback, but you made it such a big position that you're almost forced out of that position. That's why I talk about, only own as much as you're able to buy on a dip. And I think that's really a key element in, success in investing, not just around emerging markets, but just in general.
I'm your host, Melanie Schaefer. Welcome to Lead Leg Live. Now, emerging markets are staging a real comeback this year, led by strength in technology and e-commerce. After lagging U.S. stocks for much of the past decade, markets like China, Brazil, and even India are now showing renewed momentum, supported by better earnings, easing inflation, and a shift in global capital flows. According to Bloomberg, the MSCI Emerging Markets Index is on track for one of its strongest years since 2017, thanks in a large part to a rebound in consumer tech and digital retail sectors. My guest today is Brendan Ahern, Chief Investment Officer at KraneShares and one of the leading experts on China and emerging markets investing. Today, we're talking about the KraneShares Emerging Markets Consumer Technology ETF, ticker KEMQ, and what's driving opportunity in this space. Brendan, welcome back.
Hey, thank you for the opportunity, Melanie.
So let's start with the big picture. International and emerging market equities are finally showing signs of leadership again. What do you see as the main drivers behind this rally, and what makes you confident it can continue into 2026?
I think there's a whole host of issues. One of them is just the incredible outperformance of U.S. equities over the last really 16 years. Since the GFC low, we've seen a vast outperformance of U.S. equities versus non-U.S. equities, including emerging markets. But I think part of what's driving this rebalancing is very high valuations in the U.S., as well as currency depreciation of the dollar, and some of the concerns around just some of the political dysfunction, the level of debt of the U.S. government today. So I think we're seeing a little bit of a rebalancing effect, and a lot of that, an element of that money is going to seek out growth opportunities in emerging markets, which is really what KEMQ is built for. It's really this growth factor for emerging markets.
Yeah. And so, Brendan, you've been highlighting global tech and e-commerce as standout sectors within emerging markets for a while. Is it more of a short-term rebound, or are we looking at structured shift where growth is coming back globally and for a while?
Well, I think one is part of what's been made non-U.S. equities such a poor asset class is really the composition of the indices. That if we looked at something like MSCI emerging markets, 50% of the benchmark was in financials and energy 10 years ago. And if you include industrials, materials, and real estate, it was really a value factor during a period where the market and investors favored growth equities, and technology within MSCI emerging markets was only 10% of the index. So I think part of what's driving this is that investors recognize that there are global leaders, companies not just in China, but in South Korea, in Taiwan, in South America that are really geared. These are really tech companies, and those companies are actually performing really well. And if you remove some of these value sectors, banks, financials, insurance, energy, if you remove those companies from the definition of emerging markets, lo and behold, you can get some really strong returns, as we've seen in KEMQ, really one of the top performers, if not the top performing across both active and passive EM strategies.
Yeah, and I want to just pivot now and talk a little bit about politics. I mean, today, Epstein and the new documents that have come out are dominating the headlines. But in general, geopolitical tensions and trade headlines still dominate much of the conversation usually. Yet we've seen companies like Alibaba and PDD Holdings outperform the S&P 500 despite those risks. Do you think the larger geopolitical concerns are still overly priced into these markets?
Yeah, I think that's an issue if you're out buying the U.S. ADRs of a lot of these companies, particularly on the China side. But in general, yeah, these companies, when they're listed solely here in the US, they're going to have a high degree of volatility. They're not going to trade on fundamentals. They're going to trade on tweets and the news feed. And that's why we've really migrated our strategies to holding the local shares when we can, when that local shares has ample liquidity, just because you just see on a daily basis where this kind of media narrative is so negative. And I think it really weighs on the ADRs. And that's why in the case of, say, Alibaba, we don't hold the ADR. We hold 9988 and in Hong Kong, because investors in Asia, when they get that same news, they recognize with what it is. It's just clickbait. And so, if you hold BABA US, I wish you good luck, because it's gonna be absolutely absurdly volatile because of this media narrative makes it really volatile. And yeah, I think that's part of the benefit of an ETF is we're going to do something for you that's going to be really hard to do, which is hold a Hong Kong, South Korea, Taiwanese stock locally.
Can you talk a little bit about the earnings that you've seen starting to come out, and particularly some of the companies that are lagging what we've seen in the reports?
Yeah, I think we're kind of coming into Q3 earnings season, and some of the China companies, some of the China tech leaders, very strong results from Tencent, JD, Bilibili. Tencent, one of the largest companies in emerging markets, was able to grow revenue 15% year over year. They did almost $27 billion of revenue for the quarter. So I think Tencent's kind of a good example of a really a tech leader just listed outside of the US. The other difference is it's cheap, that it's not at all-time highs. The stock is actually below its all-time high back in 2021. So I think that's part of what's leading a little bit of this rebalancing effect is this valuation disparity between US tech and if it's China tech or EM tech. These stocks have upside potential. And I think that's a little bit of a harder argument for some of the US names based on really the very high valuations.
And if you're talking to advisors or to investors about when a good time is to enter, is now a good time, or do you see a pullback coming following the earnings reports?
Yeah, I mean, in general, I think market timing is very difficult. In my own personal account, I've probably proven I have not done it very well. I think ultimately, emerging market growth investing is an asset allocation decision, and I think that's it's a permanent part of an asset allocation, and it's got to be volatility adjusted. So certainly within a broad asset allocation, EM might be between 5 and 10% in a portfolio based on one's risk profile. So within that, we're probably representing half of that position. So I think the key is you don't want to own so much that if there's a pullback, you're not willing to add to the position. I think that's where people have gotten themselves in trouble is you get a kind of a good news, like we're seeing with some of the earnings, you get this proverbial green light, and then you get a pullback, but you made it such a big position that you're almost forced out of that position. That's why I talk about, only own as much as you're able to buy on a dip. And I think that's really a key element in success in investing, not just around emerging markets, but just in general.
Yeah, so that's what I want to get into more about investors who are looking at their portfolio as a whole. How much, or I think you said about 5% of KEMQ, but in terms of emerging markets, how should investors be looking to diversify beyond just US exposure? And can you talk a little bit more about some of your other ETFs?
Yeah, I mean, listen, broadly speaking, the US equities are 2/3 of the all country world index. So you're always going to have a healthy exposure to US equities, and certainly a lot of US multinationals have a lot of foreign revenue. I think what we're seeing is what's driving a little bit of the rebalancing effect is just doing the simple valuation comparison, right? And it's almost become a joke where some of these individual US tech names you could buy every company in emerging markets. I mean, they don't necessarily ring a bell at the top, but I think there are some signals, some potential signposts, or at least a little bit of a yellow caution. So again, most portfolios, you're going to have 5 to 10% emerging markets, and we think that KMQ should be at least half of that, probably barbelled with a good value EM strategy, and you can kind of rebalance across those two. But yeah, we are constructive on the space just because we certainly see a lot of demand from non-U.S. investors for what we're doing with KEMQ, just based on some of the dollar depreciation taking place outside of the U.S.
And finally, Brendan, for anyone watching who wants to learn more about KEMQ or your research at KraneShares, where's the best place for them to go?
Yeah, certainly KraneShares.com and KraneShares.com/KEMQ. But certainly we're always available at info@KraneShares.com. Like yourselves, customer service is job one, so we're always available. And certainly, we produce a wealth of research. We endeavor to earn the trust of investors through our data-driven, non-hyperbole-driven research efforts. And I think that really explains, why we have such a following in both the emerging market and China space today.
Yeah, absolutely, Brendan. And it's great to have you back on the show. And thanks to everyone else for watching. Be sure to like, share, and subscribe for more episodes of Lead Leg Live.